Ladies and gentlemen, my name is Uehara. Of course, that I'm now not the British, I'm Japanese. But thank you for giving me a chance to talk about the London market today. It is a very difficult theme for me, and my experience in London is just 4 years. And even though that my whole experience in the insurance industry is more than 30 years. Maybe my experience in London is slightly longer than Downing Street cat rally, but you know that I hope I can talk about the London market from the international participant point of view. You know that actually the last 3 years I came to London 2008. And I learned a lot. Actually, the 3 years in the past is a really tough year for everybody in the world, but especially for London market players like you guys. And we should not probably be overconfidence in the insurance functions. We learn a lot, and last 3 years is a great moment for lesson. And, but you know that my experience in the last 3 years have full of implications how we can do better. And I'm very happy to share my view with you this morning from the international participant point of view. Firstly, 2011, this is stating the obvious. It was a very challenging year for every insurance companies, insurance guys. And it was notable for its unprecedented nat cat events. And this is the costliest catastrophe year on record, overtaking 2005. We have to remember that is why people buy insurance. Because of the nature of what we do, we have a responsibility to do business the right way. Despite some of the headlines which have dramatized these tragic events, we are an extremely resilient industry, and we have a vital role to play in supporting and people through difficult times. And so landscape we are operating in is turbulent. What I a little bit touched on at the beginning. Last 3 years especially has a very difficult years for insurers. So what did we wake up to in 2012? On all of our priority list is a need to deliver the profit in 2012 and beyond. However, the landscape we are working in is more complex than ever before. Let's quickly review some of the key challenges. First one is the market cycle is broken. This is a statement made by Mr. Charles Franks, CEO of Kirin. He's sitting there. So if you have very tough questions, I'm very much welcome to him, not to me. He will, I hope, he will be happy to answer to you directly on my behalf. Thank you very much. So, according to him, and I echo his statement, a traditional loss-driven market cycle is broken and is effectively redundant. Historically, the market has tended to harden after a significant event, usually a catastrophic event. So, we expected that the same after each major cat in 2011. However, the market has not hardened in the way we expected it to. Secondly, the risk model change. risk model changes have increased the amount of capital we need to underwrite the risks we wrote yesterday. Same risks are substantially reducing our return on capital. Therefore, any signs of market hardening in some cat-exposed areas are actually illusory. This risk model change has model creation for unmodeled risks will be the realistic trigger to revisit the current pricing. Thirdly, I'd like to touch on economic environment. The economic environment has been extremely challenging. The investment income our industry has relied upon to protect ourselves from the impact of nat cat losses is gone. Underwriting discipline is now vital for our long-term competitiveness. On the other hand, ironically, under ultra-low interest environment, our relatively resilient industry attracts transient and short-term capital. It needs to be deployed in the most effective ways for us to achieve growth. Finally, the risks we are insuring have become more complex. Take Thailand as an example. Insurers need to really understand, underwrite, and revisit network risks relating to complex supply chains. These efforts should not be limited only for nat cat risks, but also man-made risks, such as terrorism and the pandemic and cyber risks. For better understanding of complex risks, insurance companies are willing to help clients to understand their risks. And at the same time, clients and brokers also need to identify and explain about exposure if they have to be properly insured. In 2012, short-term confidence may decline. However, the London market companies have made tough choices and transformation in business model since 2008. I believe we are more ready for the turbulent than 4 years ago. Then, we have a real opportunity in our hand in 2012. This shows total insured losses for the global insurance industry from the nat cat catastrophes reached about over $100 billion US dollars, maybe the highest in history, only around the 45 billion in 2010. On the other hand, the total 2011 economic losses reached around 400 billion US dollars, the highest amount in history, compared to $220 billion in 2005, the second in history. It is almost 2.3 times as much as bailout package for Greece, aimed at restoring growth and achieving debt sustainability, which was agreed in February. That means the insured losses is just 1/3 of the entire economic losses. This fact suggests me we still have plenty of room to make effort to bridge this gap and to grow through this opportunity. However, we need to focus our effort very carefully. Then let's take a look how our risk portfolios are becoming more complex. Risks are changing. 2011 was the year that we rediscovered that we are still not sufficiently aware of some risks, especially those in emerging markets, where reliable risk model has not yet existed. Political uncertainty and climate change are also very important factors to make risks change. Secondly, the correlation is changing too. In the wake of Japan and Thailand, the contingent business interruption has been highlighted as global correlation and network change being significant. The scale of the losses for these risks are astronomical as the global connectivity develops significantly. Thirdly, exposure is changing. Another important factor which makes risks more complex is the global economic power shift. Especially, the rapid growth in Asia is a key. Growth of exposure in emerging countries is very fast and significant, following the industry cluster accumulation in these territories. The knee-jerk reaction from insurers has been to find another small print or exclude it, because we are not yet able to charge an appropriate level of premium for the amount of cover our clients are asking for. However, business cannot always be defensive. So, what do we do this? Firstly, by being innovative. Customers are telling us that we need to respond better to their risk exposures. We will be left behind if we do not develop our understanding of the complicated risk profiles of our clients and seek opportunities to capitalize on them. Insurers will continue to innovate for the clients as long as the price is sufficient for the risks. Secondly, providing innovative solutions to address these threats and meeting our client need is becoming increasingly important agenda for insurers. We need to listen to the customers and provide specialist products that they are asking for in order to generate our underwriting result and be stable in providing the cover for the clients to the clients with an adequate level of premium. The huge difference between insured losses and economic losses sustained last year is a wake-up call for us to take action. So let me touch on the international opportunities for London market players. The area outside US and Europe currently account for only 21% of total London's income. However, the balance of economic power is shifting. Goldman Sachs predicts that by 2050, China will by far the largest economy in the world. With India equaling the US and Brazil, Mexico, Russia, and Indonesia all have overtaken Japan, UK, and Germany. It is essential that the London market of the future establishes in these areas the same reputation and relationship as well as we do in the United States. London has always been at the forefront of insurance innovation, and we need to ensure that we maintain that position as these economies develop. I've heard many CEOs said the Asian market is one of the most strategically important for them. Then, do you really understand the risk of those countries? As said before, we need to improve our understanding of the risks in these areas. I think we have to contend with more volatile and uncertain climatic, geophysical, and geopolitical environment if we want to penetrate into the emerging and growing market. And we need to focus our energy on turning that into the next profitable new business area. When we discuss the risks surrounding the emerging countries, I think we need to look at how we can do better cooperate with the local government to provide solutions. In some areas or some countries, the problem of availability and affordability was exposed in 2011. This has been significant challenges to restore the economic recovery in these countries. It is crucial for local government to help private insurers to develop a realistic resolution scheme, such as a state-backed NatCat fund or state-backed terrorism fund, to kick in. I want to slightly touch on M&A issues. M&A, if done well and selectively, is also a good example of how embracing international opportunities can work well. We've seen a lot of M&As in the emerging market over recent times, and London players have still plenty of room for the opportunity. On the other hand, the reverse flows sounds interesting. The benefit of long-term successful partnership are demonstrated by Tokio Marine's acquisition of Kirin. Building strong and long-term partnership with financially robust international businesses can enhance distribution, provide intelligence insight, and access to the emerging market. It also supports risk diversification strategies, which is very valuable asset for insurers. The London market is a world-class center of excellence for underwriting. It has the skills and capacity to play a prominent role in overcoming these challenges and taking advantage of this opportunity. Nowhere else in the world has a concentration of skills, expertise, and capacity to overcome these challenges. It is where talent and capital come together. Aon has relocated here. The number of suitors for Hardy and Omega and players keen to enter Lloyd's via M&A or other routes. It is an exceptionally attractive platform. So London market is a central platform for delivering Tokio Marine strategy. From my perspective as an international participant in this very important market, here are 6 reasons why the London market has so much value. First one is, this is my most impressive things and very common agenda, but underwriting discipline. It has penetrated through the market and helped it to maintain its profitability for a long time, especially in Lloyd's. This is very important for us to monitor the price movement and take a quick action for price adjustment. Second one is the international market. New York, Singapore, and Tokyo. Also quite a large insurance market, but most of the risks underwritten there are from domestic or regional markets. London is the only market where we can give clients access to a diverse and specialist portfolio in one place. And we can also diversify our own portfolio here. Thirdly, I would say the characteristic of subscription. By this market practice, the London market can provide huge capacity and can have appetite for niche specialty risks. Fourthly, market intelligence and the people. World-class people are working here and working near the famous Lloyd's of London. Quality, cutting-edge information can be easily obtained here. Next is innovative products. Providing innovative solutions to special industry sector niche risks, as well as reinsurance solution to lead on finding solutions to global insurance, is a definitely value proposition of the London market. Finally, the regulatory environment. It is stringent. However, the international players can learn a lot from it. Catching up with advanced UK regulations from the macroprudential and market conduct point of view provides insurers with competitive edge in competing in the global insurance arena. So finally, in addition to that, I also need to glance at operational effectiveness of London market. The future success of the market will depend on whether we can provide disciplines aimed at the problem solving of complex risks, coupled with the business model process improvement in the market. This includes the next step of exchanging and project Darwin and so on. Standardization and simplification of the business process is always vital for insurers to provide easy to understand and very transparent products to the customers and reduce our expenses as we are competitive enough. And also, Solvency II and market conduct initiatives developing in London market also give the insurers sustainability and competitive edge in the global insurance space. So in summary, I am very positive that the London market can create our own opportunities for growth by expanding its products portfolio to address emerging threats and looking at as a benefit of exploring the international markets outside of our comfort zone. Underpinning of all this, I believe that we can maintain our position as a world-class center of excellence for insurance under the new regulatory regime. Thank you very much.